So talking real estate is therapy for me. I mean, it's really good. Again, you have to learn how to be an architect and putting deals together. Creative strategies is all fun. There's going to be some lessons that you're going to learn. You're going to take a few lumps, but you stay at it. It's like anything. Once you learn it, it becomes easier to understand, and you know the jargon helps you make better decisions. You become a better person that does due diligence. That's the key thing that I can leave with listeners.
Welcome to the Path to Passive podcast, where we talk about building wealth and empowering lifestyle through commercial real estate investing for tech professionals. I always wish that other tech professionals reaching financial freedom had documented their journey along the way, so I'm doing it for the rest of us. Join us as we explore stories, many failures, and lessons learned along the way. I hope you enjoy and subscribe. Your business only grows as fast as you do, and my guest today is living proof. This episode, I sit down with Fuquan Bilal, a 26-year real estate veteran who has survived multiple market cycles, rebuilt after losing everything, raised over 50 million capital, and reinvented himself again and again. We talk about what decades in real estate really teach you, the kinds of lessons that most investors never learn because they never stay in the game that long enough to see the full cycle. From flipping 200 homes before the financial crisis to discovering the backdoor world of notes and building multifamily portfolios in the Southeast and creating luxury spec homes in New Jersey. Fuquan breaks down the mindset, the pivots, and the personal growth behind every breakthrough. And my favorite moment, though, is when he said something so relatable that I had to laugh. Real estate talk is therapy. So if you're a tech professional who wants to think more clearly about wealth, risk, resilience, and long-term opportunity, this episode gives you the mental models from someone who has truly been gone through it all. Let's dive in. Ladies and gentlemen, welcome to another episode of Path to Passive Real Estate Investing. I'm your host, Stephen Arita, and today I have the chance to sit down with Fuquan Bilal, who brings us a lot of experience. And what I was really excited to have it on today to talk about is just the gamut of experience from single family to notes, his experience going from, and the aha moments from single family to multifamily investing. And by the way, over 50 million in capital raised. So we definitely have a champion on the podcast today. Fuquan, if you could please introduce yourself to our listeners, sir.
Thank you for that introduction. Fuquan Bilal, CEO and fund manager of NNG Capital Fund. I've been doing real estate for about 26 years, and 50 million is actually a small number compared to some of my mentors, and those guys have $1 billion in assets, and they're still pushing the front line. But I am grateful for the journey and all the things that I've learned, and hopefully I can share a few nuggets with the listeners today.
Yeah. I mean, absolute, like you're saying, it's always amazing to me because I can ask you about like your background. You can say you start from this and move on to this next thing and so forth. But like you said, 26 years of experience, and walk us through that, because just saying that you went from asset to asset doesn't really give acknowledgement or credence to like all the lessons learned along the way. So
Yeah,
it was a little
and all the lumps too.
bit.
Don't forget the
Yeah.
lumps. The
Yeah.
lumps comes with the lessons.
Exactly. You have to stay in the game the entire time. It's time in market, right? So
Yeah, it's been an interesting journey. I am market cycle tested. That means I've been through the GFC, global financial crisis, when that happened, and that really taught me a lot. I had to go more inward, right? It's I read something where it says your business will only grow to the extent that you do. So it's a lot of planting seeds and resetting the mind, because real estate was my identity at the time. I've been in business at that time probably for about 7 years before the GFC happened. And I lost a lot. I had to start all over again. Made all my investors whole. Took a couple of years rebuilding. And about 2010, that's where you and I were talking before we pressed record about the note business. I got into that part of the business, and it was really exciting because it was something new. It was an opportunity to get deals directly from the bank who originated them. So that was a great beginning of a new journey for me.
awesome. So 7 years in business before the GFC, the Great Financial Crisis. Many of the listeners are probably somewhere between 30 to 35, and so this is maybe close to home for some of them too, right? But you were in single family. You did what kind of stuff? Single family.
Flips. It was purely flips, and that was one of the biggest mistakes that I made because the small cash flow wasn't sexy to me. The big
Mm,
chunks of cash were from the flips, right? So I started in my own neighborhood where I grew up at, and that was one of the things that made it exciting because I was one of the people that was able to go back. One of the many people that I would say that because a few other people did it as well. Went back and revitalized the neighborhood, made the community better, taking a lot of the blighted properties. They were like really cheap, right? So they were low income areas. So we got the opportunities to partner with the other investors and turn those properties around. And, we sell them to buyers that were from other towns, using them as rentals. And that was really a great feeling rather than that wave from that time all the way into the global financial crisis. So,
yeah.
yeah, we did a couple of almost 200 homes, through that time period, buying, fixing, and selling. So, learning the construction business, different
Hmm.
parts. It's really a people business,
Yep.
if you look at it.
Yeah. You were talking about blight. Where was this? I've looked into markets in like Detroit and Michigan, those areas. Where are you from?
I'm from Newark, New Jersey, Brick City. So Essex County, it's a major airport hub in Newark. There was riots in the 50s. A lot of properties got burned down and stuff like that. So, it's a really good area, it's good people, and it was grateful that I was able to go in and add value. And that was really what gave me my feeling of importance. And that kind of transcended into other things later in the years after the market collapsed. So one of the biggest mistakes that I made at the time was I didn't build a rental portfolio, so I had no cash flow.
Got it.
And I learned very quickly that cash flow is king. When a market transition and the banks were not, pulling a carpet from under your feet, so to speak, with deals that were almost going to the closing table or had closing dates scheduled that canceled.
Hmm.
And it was just doom and gloom for the next few years to come. But we made it out of it, made myself more resilient, went deeper inside, and was grateful for the opportunity to rebuild.
You mentioned something interesting here, and I got to ask this before we get into the note side, make that transition. But you were talking about that the business can only grow as much as you can
As you
get
do,
your
yeah,
is,
for
and
sure.
so that's I've always heard it is that you are the chokehold of your business as the owner, and so
Correct.
I'm kind of curious because I've heard you drop these kind of nuggets of wisdom. How did you educate yourself along the way? Was
Oh,
this
books. Books are the seeds that gets planted.
yeah?
And you make winter your season. I was at, I forget, Business Mastery, Tony Robbins. It was,
Ah,
winter is my season.
there you go.
It's reading books, planting a lot of seed, but taking action on what you read and implement. Whether it's a development book, a leadership book, whatever it is, right? Just not reading to read. Like implementation is key. And I'm the type of person that if I have passion for something, right, or faith, right, I'm going to definitely execute if I
Dude,
have passion and faith.
I love it. I'm going to ask you for book recommendations at the very end, okay?
Yeah, yeah.
But
I
yeah.
was reading something this morning, not reading. I think I heard something. It was from Think and Grow Rich,
Hmm.
Napoleon Hill.
Yep.
Says faith is the fire that burns without fuel. It's like that's crazy. I
The
love that.
is the fire that burns without fuel, like it just keeps on
Yes.
going. And
Yeah, faith is the fire that burns without fuel.
yeah, those that's Tony Robbins talking about
Yeah.
repetition is mastery. Yep.
This is true. This is
Hmm.
true.
So talk to us. So 200 homes in those 7 years before the GFC, you're pivoting to notes because I want to give us this background too for the listener because you have some great insights about notes. Notes is really cool, but I want to hear how did you make that pivot?
Yeah, it was by accident. Notes is at the time when I learned it. I used to say notes is the greatest investment in the universe because it's really laptop cell phone. You're not running around chasing contractors, doing construction, flipping houses. You're sitting at your desk, with some information. At that time, it wasn't a lot of regulation when I got into no business. You can literally just call a homeowner directly and negotiate either a settlement payoff or some type of repayment plan, loan modification.
Hmm.
And you had the ability because you purchased the paper from the originator to collect those payments and then get the note back, reperform it, and sell it. So just to give you a case in point, if there was primarily we focus on smaller loans. They used to call them the redheaded stepchild, second mortgages.
Yeah.
there was a lot of back then 100% financing, 80/20. That how they would structure deals back then. So we would buy the second mortgages. We get them for a bigger discount. A $50,000 loan at the time would sell for 10 cents on the dollar. So you get it for $5,000. And you can structure either a $15,000, $20,000 payoff with the homeowner and get profit right then and there, or you can get them going on a repayment plan with a 30-year amortization and have the face value of that $50,000 note that you paid $5,000 for. So, and then you can sell it after a season for maybe 25,000, 50% of the unpaid principal balance, and still give the buyer a good return. So when I learned all that, it was just like, wow, I never
Mm-hmm.
even knew this part of the business existed. This is some backdoor, you know, laptop, cell phone. I just fell in love with it. And underwriting and going through the process, learning how to value them, pretty exciting. Building out a trade desk, doing education to educate others on how to do it.
Nice.
You know, to help also build a downline of buyers. So that was a very exciting time. And then things started to change. More regulation, Dodd-Frank, and things started to come out, which required like certain collection license in various
Mhm.
states. And we adapted. You know, if you want to play the game, you have to play by the rules, like you say,
Yeah, you
Monopoly,
do.
right? So we adapted. But you know, as time went by, especially when COVID hit, we kind of left that strategy alone because it's trying to foreclose on people, you know, during COVID or you know, threatening foreclosure really wasn't, you know, good business. Just
Yeah.
didn't feel good, and the attorneys made most of the money. So there's still money in that space, though. If you are, you know, buying, you have to take down larger trades to get bigger discounts. So
Yeah,
a lot of regulation change.
I've heard you mention that, and I want to ask you about that too. But just for the listeners on that too. So you're able to get these notes, which are really, in this case, at the time, the second mortgages on homes, and you were able to get them at a discount. So if there was like 20 or I don't know 30K on it, you could get it for like 5K
Yeah,
or
like
so, way
yeah,
discounted.
anywhere from 2 to 3,000. They
Wow.
treated them like the redheaded stepchild. The banks gave those away because they wrote them off anyway. They book charged them off, and they just sold them on the secondary market. And basically, it was a lien on the property. And a
Hmm.
lot of people don't know first and second mortgage have the same rights. It's just one is in first position, the other is in second. So you
Yeah.
can foreclose from second positions subject to the first. It's like having an option on a home, really, because you're paying 5, 10, 15, $20,000 a loan. You know,
Yeah.
hundred
And
thousand
anything
dollars back then.
and anything that you made over what you bought it for was profit. I mean,
For sure,
provided you
for
you
sure. Yeah, yeah,
calculated
for
your
sure.
own time and effort, right?
Yeah, it's so many things. Really, I always told this story. My mom, she had early dementia, so I had moved in with me, and this was around the time I was first learning to know business. And I remember, you know, I had this guy got divorced after the GFC, so you know, she came to live with me a few years later, and I walked into the house because I just came from a note session, like where I used to go get education and training from my
Hmm.
mentor, and I learned a strategy called where you can hypothecate a note. And I came home and I just like had this glow, and it was so funny because my mom was like, "You found her," like she thought I like found my next love of my life. But
Uh,
I fell in love with the note business. I was just so excited from the information I learned that night. I came home and I just had this glow. But you can borrow against notes also, you know, through a hypothecation strategy because it's an instrument. You can borrow on it just like you can borrow on a property with a deed instrument. So when I started to learn those different strategies and how to arbitrage and everything else, I was just like, wow, this is right up my alley. I mean, I would teach also to people things that I learned and share information as well in
I
the
think
note
that's super
communities.
cool because that makes that go in deeper, definitely. So you just know
Yeah.
it when you can answer those questions. That's kind of funny that you had that same kind of glow, but it's cool because when you get passionate about something, it stokes your energy, that
Yep.
fuel, so to
Yep.
speak. In this case, a different
Yeah,
kind
that
of
was a
fuel.
good transition. We pivoted after COVID, though. It was some things that we've done along the journey. Even probably, I would say we got into the note business somewhere around 2010 with my own capital. 2013, I created the first note fund. That's when NNG was born. National Note Group is NNG stands for.
Got
And
it.
then basically from there, we raised capital for notes. And then 2017, we started to pivot a little bit because we had cash flow from notes. And I wanted to get back into the flips because I
Hmm.
had relationships now with banks or art that was selling REOs. And a lot of people in the note business didn't like to buy in New York and New Jersey because they're judicial states, which means you have to actually process a foreclosure, wait a year or two before you can work something out. So they really didn't buy those, and those were sold cheaper. And we connected with a few banks. We started getting a lot of REO properties from them, buying them directly after they foreclosed on them, and then we started to do more flipping along with the notes.
Yeah.
And we did that for a while.
Yeah, I mean, you really learn the language of finance, basically, right?
Yeah,
Because
yeah, yeah. I
if
was
you,
telling my son the other day, he's like, "How can you be in this business for so long and not be burnt out?" I said, "Real estate is the one puzzle you'll never figure out.
yeah,
So,
there's
so
always
many
so much
different
more
facets."
stuff.
Yeah. Mhm.
That's cool. So you talked about single family move to notes, which is just an absolute logical transition as well. And along the way, not only are you learning finance, but you're learning capital stack, right? So understanding second position, first position. We talk about that, a bunch on this show as well, because if we talk about commercial assets, then we have to be talking about that stuff. And if I heard correctly somewhere else, you have a mez fund as well. Is that right?
Correct. Yes, we have a mezz fund. There's a company called Invest Clearly. If people are interested, investclearly.com. People are interested in checking information out on that. We have it's like the Google review of investments. You can go there and basically see what other investors are saying. But we have that opportunity there. That's more like an income fund. So if someone is looking for income, that's a great opportunity for them to earn anywhere from 8 to 10% return on their money. There's terms of 1 year, 2 years, or 3 years, whichever one
Nice.
they want to go into for fast liquidity. But we use that as an income fund to stabilize assets that we have. So we have a two-pronged strategy to date. We do multifamily rentals and also luxury spec homes. And the evolution pretty much started of that after COVID. When COVID hit, as you know, everything was
Mhm.
shut down. We were one of the essentials that can continue to work because
Yep.
we did construction. So we pushed forward through that. We made a great return at the end of that year. It was a lot of challenges with sponsors who own multifamily, stopping distributions and doing a lot of stuff. We kind of pushed through. We made a 10% net gain that year,
Nice.
and it was really good, in spite of what happened. And then we started to raise a lot of capital at that time as well. So what we decided to do is because we had a mass exodus from New York coming to New Jersey, the properties were being sold 30% over list. We had a huge rental portfolio, and I just decided, I didn't want to play the COVID games with the tenants anymore. So we
Yep.
divested that portfolio, and then we started to buy multifamily in the Southeast with the same strategy to provide housing for low income families, battered women and
Southeast of the
children.
U.S. Yeah.
Yes, Alabama, Georgia, to be
Okay.
specific. We targeted those areas because they are, you can do eviction quickly. There's no snow. Taxes are cheaper.
Yeah.
So, you save a lot of money in expenses. And it helps you grow the portfolio faster that way as well. And it helps us create our impact on a larger scale also by providing that type of housing and generate, because HUD rents are comparable to market rents. So
Yeah.
you make great returns doing that. It's just learning how to strategically manage that type of asset.
Plus, dollars
And
go a lot further there too versus somewhere in Jersey.
correct. I mean, we had a bunch of multifamilies in Jersey that were like 4 units, 6 units, 10 units.
Okay.
It's just too many
Yeah.
properties to be running around shoveling when it snows and
Yeah.
everything else. So that was a great move to divest that portfolio, take the war chest, so to speak, and go to the southeast and start, building relationships down there. And that's still going. And then we also pivoted on our flips that we were doing in the low income areas to higher income areas, which is
Mhm.
we started to do luxury spec homes because we were raising a lot of capital at the time during that transition after COVID, and we started to deploy the capital into better quality assets. So, that's kind of the journey we've been steadfast on since then.
So let's simplify that a little bit because you went down giving a huge overview of things. But what are the assets that you're in right now? Because you talked about multifamily, and then
Multifamily
you
and
talked
luxury
about
spec
luxury
homes.
spec homes.
Yep,
Okay.
yep. Which is different from fix and flip. So the fix and flips were like the bread and butter home that you can get an FHA loan, anything less than 500,000, right? So you're still selling to a middle class. The medium home sale price now in my neighborhood is 600,000,
Mhm.
where we're doing our business at. We were in areas where at the time it was probably you resell it probably for 400, 350 at the max, but you're getting it for low hundreds.
Well,
You,
I'm mostly curious. So from the so note business, but then you exited that, and
Well,
so
we
you're
stopped buying notes. Yeah,
okay.
we
And
stopped buying notes at that time, and we started to focus more just on the rentals and
on
the
single family
flips.
home rentals because you wanted to
Correct.
build the portfolio there.
Hmm.
Got it. And then how does multifamily come into the picture here too?
Yeah. So in New Jersey at the time, our strategy was rentals. So we transitioned from doing notes, and we added fix and flips.
Okay,
And then at
added
the
back
same,
fix and
yeah,
flips.
we added fix and flips to the strategy in the same fund. And then we did another fund a few years later because we started raising capital where we had a three-pronged strategy, right? It was diversified hybrid investing, we called it. And we had income from cash flowing notes, income from rentals, and income from fix and flips,
Got it. All in the
right?
same
So
fund.
all in the same fund because I
Okay.
had built out over the years, those different divisions, the note business, right? And
Hmm.
then we already was doing the flip, so we kind of added that on. And then we started to connect with banks that was giving us a lot of REOs. And then we started seeing smaller multifamilies in New Jersey that would consist of a two family, a three family, a four family. And we started to buy that. So it was a three
Okay.
pronged strategy at the time.
And the thinking there is so that investors can get that blend from these different assets if they
Correct,
go into the
correct.
fund.
So if the market shift, right, and there's a major job loss, then more notes will be available, right?
Yes.
Because
Yes.
foreclosure. So it was diversified hybrid real estate investing is what we
Super
call it
cool.
because we can switch. Actually, trademark that, and it's like we can switch levers, over the market. What I just did was took the experience of the different verticals that I was in real
Hmm.
estate, the notes, the flips, the rentals, and just started to expand on that and like have three different divisions within the company that focus
Got
on
it.
that.
Is
Then
so
that
is the
that
fund
changed though, right? Go
is
ahead.
the fund what you divested, or was the assets in there?
No, it was the assets in there. So we had purchased a bunch of smaller multifamilies at the time, building up to COVID, and then during COVID, you had a lot of tenants not paying rent and a whole bunch of things happening, and then it was like a dead cat bounce. The market just like exploded. So we looked at our portfolio and said we have a lot of these small rental properties here, and we also had some low income area flips that we were doing. Why don't we just divest the rental portfolio and start to make that rental investment portfolio in the southeast, and
Okay.
then we'll move up to luxury instead of doing flips in low income areas, right? And that's what we started to focus on.
Got it. Why? Okay, got it. So sold those assets and then was moving down to the southeast as well, and that was kind of like an opportunity for you to kind of pivot as well to a different asset class. Well, I wouldn't say asset class,
Absolutely.
but
Well, it is a different
kind of.
asset class because what happens is you would think if you're managing a 6 unit multifamily, that is the same process as
No
managing a
way.
120 multifamily. Right?
Well,
It's
also,
completely
I
different.
mean, great call, of course. Like 5 plus, it's technically multifamily,
Yeah,
right? Or the
yeah, yeah.
six, but that's just a different animal from 120. But also, I was thinking the bigger 100 plus multifamily, but also the luxury type of single family homes, right?
Yeah, well, that's just process, right? So I started off doing flips, and you do a couple of hundred of them. It's like you already know the process, right?
Yeah.
And making a transition to new construction, luxury spec homes was because it was actually easier. The cost, you knew the cost going from the ground to you know what the cost per square foot would be. When you were doing a flip, it was unknown. You would gut the place out. Now you have foundation issues. There was things that even your 15-20% contingency didn't cover.
Yeah.
And he's like, I just did all this work and I made $5,000 on this house.
Totally.
Spent 3 months. So,
I know.
you tend to want to stay away from that. So the luxury spec bills are more predictable and way more profitable. It's like
Where are
almost
those being done?
those are being done in North Jersey. So it's still here
Okay.
in North Jersey, about 30 minutes, 25 minutes away from the city.
Got it.
Uh, that's kind of where we do that at. We focus on 5 counties, and
Nice.
the houses sell anywhere from $1.5 million to $2.5 million. Those are the
Ground up.
resale price. Yep, ground up or something that we'll put an addition on and go in and just make it luxury. We still got the interior out, upgrade, mechanicals, new electrical stuff like that.
Got it. So now today you're doing the spec builds, the ground up builds in North Jersey. You
Correct.
have been acquiring more portfolio in the Southeast,
Yes.
and is
Two-pronged
there
strategy.
got it, and in the Southeast, those are bigger multifamily and any
Yes.
other assets down there.
Absolutely. Our strategy there is anywhere from 40 to 150 units. And we like the smaller units because you can pin them up against the bigger units. You can have the same team manage those
Hmm.
and you can sell those off quickly, right? A 40 unit will sell faster than a 150 unit building.
Yeah.
So the goal with those are short term. We get in, we improve management, we go and do some curb appeal, and basically within 3 years be able to flip that. And the ones that are bigger, 100 units plus, that's a 5 to 7 year play.
Hmm. Totally.
Mhm.
I heard this, you talk about this somewhere else, but I'd love for you to expand on it here. Just, the thinking that if someone is, in the 26 years of experience, right, you've went in these different areas along the way, just kind of stacking these skills. But tell me about this different ball game from, single family homes to multifamily investing. What were some of those ahas for you, or those insights?
Well, it's more so. Let me just back up because I see you got the who, not how, your book
Yeah.
collection. You ever read Scaling Up
Not yet.
or
Not yet. It's
EOS? It's
on the
really
list.
good. It's like Rockefeller Habits 2.0.
Yeah.
But it's a really good book that talks about operating systems for a company, and it talks about the four parts of business, right? So people, strategy, execution, and cash. And when you
Sure.
go from a smaller property to a bigger property, you really have to really learn how to master those four parts of that business. And
Hmm.
we self-manage now. A lot of time, our people were the property managers, the vendors that we use to kind of help us, get to our goal. But what we've learned very quickly is that they're just there to check off the box and get stuff done. They're not
Yep.
trying to be strategy and squeeze water out of a rock. So we took that over, hired directly boots on the ground, and we stayed focused on those four parts of the business: people, strategy, execution, and cash. And
Hmm.
that's the major difference. Going from a mom and pop to a bigger multifamily is what I was trying to say. It's a whole different part of the business. Yeah, it's a whole different business going from a smaller six family to a 150 unit building
Where did
operation
you?
plan.
I mean, you didn't learn those things from books.
No, masterminds. I'm a part of masterminds and books. Believe it or not, yes, I read a lot of books. It's one of the best ever multifamily. It
Oh
was a
yeah.
great book that I read years ago. I think I read Rod Cleef book on investing in multifamily. Well, he
Sure.
was actually in CG Collective Genius in my mastermind. And there's a lot of guys that are really big in the multifamily space is in the mastermind that I belong in, and getting their literature, communicating with them, learning from them directly, and it's really learn by doing. Right? It's the best way. I'm let me rephrase that. Right? When I learned the note business, I went over the hill and got the arrows in the back
Hmm.
first, right? I put my own capital and I was able to come to investors with case studies. When I made the transition to multifamily, I kind of did the same thing. And that's really, investors want to see that you have, an alignment with them, and you actually are on the front line as well. So we tend to do that with a lot of our investments, whether it's multifamily or, uh, you know, luxury spec homes or whatever we're doing. But yeah, I mean, you got it. You have to do that.
Where did you develop? I mean, this is all built over time. You said it, 26 years,
Yes,
right? It doesn't
yes.
happen overnight, but you know, much like you, voracious reader, clearly, always looking for different groups, looking for different people, looking for like, all right, follow the interest. If you had notes was your second or third or fourth, I don't know, love, so to speak. I'm sure there's been other things that have kind of stoked that fuel, that flame along the
Tax
way.
liens are great too. I did that for a while. That was amazing. Oh my god, that's a good thing.
And so, that's what I'm saying here. Like, where did you get this hunger for learning? Would you think it was? Can you, you know, you've done a bunch of self reflection. I can tell. And so, do you think it was because of kind of the humble beginnings and just wanting to, learn more and also contribute more? Can you comment on that? What do you think?
Yeah, I when I grew up, and my mom, when I was young, I remember she used to take me to a flea market to sell, and I just had this passion about when people would say no. How do you uh, talk about the product that makes them interested to buy? And when I started to get a lot of yeses and get a lot of sales at the bazaars or flea markets she used to take me to, that's what got me excited to learn new things about how business worked, right?
Hmm.
Or how a strategy worked. I'm a builder. I like. I grew up through adversity, also coming from a low income area, so just having that scarcity mindset that it was never enough just built that hunger and desire in me. And I always joke around about this, and I say I got used to having candlelight dinners, and it wasn't romantic type because of the no electricity, because the bills wasn't paid.
Yeah.
So growing up like that kind of help you build the resilience. And I'm inquisitive also. I like to read. I like
Mhm.
to implement what I read. So that's pretty much how that came about, and learning
Yeah.
like the capital stack and how that work and financing and all of that, right?
And testing, going
Hmm.
to see what you can do, right?
Yeah, I remember when I first found out mortgage brokers typically don't give you the par rate, that they give you, a higher rate, and you have to buy it down.
Mhm.
But they get a rate directly if they're a broker from the lender, maybe let's say 4%, and they'll say, "Hey, we're going to charge you 6%." So they get it on the back end, and they charge you a point to originate the loan.
Yep.
So when I learned that, I used to tell brokers, I want the par rate.
Yeah, yeah. And you talk about win-win wealth,
Mm.
win-wins, and building communities here too. What's your philosophy today on talk to me about how you go and scratch that itch to continue to build in your communities? Obviously, the spec builds is one thing,
Yeah, those are fun and
for it.
exciting. The other
But
part is this impact. Is
yeah.
this is pure impact. So you get to a part, and your listeners probably can resonate with this, right? As we are growing ourselves or our careers, we want to get to a point where we're making, money, right? And what you quickly learn is once you get there, that money is not the answer. You wanted to scratch the itch. For me, is what gives you my feel of importance, really going to those communities and making a difference, right? I always say this: the goal is not to just increase the curb appeal of the property to sell it for higher profits. For me, it's complex to community. All right, how do you do that? We just did like a trunk and treat for the kids at the property. Nonprofit organizations come in, do financial literacy classes. This is how you complete a resume. This is how you do an interview, like those type of workshops,
Mhm.
whether it's Zumba classes, whatever it is. You can have a
Mhm.
lot of nonprofit companies come to your function room, promote that and market that to the residents there. So it's almost like a mindset shift, right? Even teaching them how to get a home on their own, stuff like that. You can do so many things to kind of make that impact, and make money.
Yeah.
So that's the good feeling at the end of the day. And on the other side, the luxury spec home, by the time I finished developing that, I wanted to stay away from it. So it looks beautiful, but I don't even want to go there when I'm done. But that's the fun and exciting part about the business. There is some challenges there, but being able to create something, beautiful that makes a difference. Our whole mantra is quality housing, whether it's on the luxury end or low income.
Love it. Yeah, that's the community things, those experiences. It's the education, in all those different forms. So, one of the things I had asked you to share before we also hit record here was, this question. I usually, your take on this question I usually get from people I've talked to, investors, colleagues, of just like, hey, Arita, hey, Steven, you got this real estate thing. I'm really thinking about maybe I should, go to do like an Airbnb, or if I should go do like a flip. And, someone who's done probably, I don't know, it was 200 before 2008 for you. I don't know how many flips you're at now, but if someone is working 40, 50, maybe 60 hours a week, do you think maybe a flip is the right decision for them to go to?
Absolutely not. Here's my take on that, right? So what you're if you have time, right, and this is your full-time thing, right, definitely there's rooms to make great return, and there's going to be some lumps and lessons along the way. If you had the ability to tap into a sponsor or someone that has a track record, someone has definitely been market cycle tested, where they've been through some valleys and along with the peaks and everything else. And that person has a great track record, and you resonate with them, I would definitely get educated on whatever that investment, alternative investment is. And once you feel like you are educated and like and trust that person, and you're ready to move forward, you'll know when it's time. But doing it yourself is it's a lot. I'm an active sponsor, right? I'm boots on the ground. I'm out in the field. Jimmy Johnson walking the field, as they used to say, the Dallas Cowboys coach. So yeah, I mean it's not it's active. So if you don't have the time, then definitely you want to find someone that you can partner with, or lend to, or whatever the case is.
So, what types of things do you recommend for those working professionals to do instead? I mean,
Well, yeah, they can be lenders on single assets, secured by a mortgage. They can invest into a syndication, a fund, something that's completely passive. Um, Private lending, looking into those options where they can have a great return, and also some stability and peace of mind of not doing it themselves.
yeah, and I always like to say too, as they do that more and more, then they can learn the language more too, right? Then they
Correct. Correct.
move as they build their own war chest, become more and more active because they can get more leverage too in their own life potentially.
Yeah, it's learn by doing, and relationships are everything. It's when we align ourselves with potential capital partners, we want to make sure that the values are the same, right? Not everybody is into impact investing, or whatever that other sponsor or strategy have, or that state that the person is in. Everybody have their own little uh, thing of what makes them tick to move forward. But once you discover that and you see the asset class that resonates with you and you understand it, then you move forward on that.
Appreciate that bit. For all you listeners out there, go and take action. I'm not going to ask you real estate books. I'm going to ask you about books you would recommend that would develop the person. You were talking about
Wow.
Napoleon Hill.
Yeah, Napoleon Hill, Think and Grow Rich. I'm sure everyone's heard of that, but my favorite is Dr. Maxwell Maltz. It's
Mm,
psycho-cybernetics. He was a plastic surgeon that he actually used to turn his clients away because what he discovered was, a new face, a new nose, or whatever, it doesn't change who you are inside, right? You have to create a winning self-image. And that was one of the first books that I read after the global financial crisis, and I read it a few times because it kind of hit me hard,
mm,
because my identity was real estate, and I remember it was crazy. We were doing probably like 5 or 6 flips a month, and when the global financial crisis had the music, it was like the music cheers, right? The music
yep.
just stopped, and that was it. And I remember laying with my back on the bed, looking at my ceiling fan, like, what am I going to do? Like, I didn't. I was real estate,
Yeah.
and reading that book really helped me shift my mindset, believe more in myself, and create a winning self image. And I would highly recommend that. That's one of my
Devel-
favorites.
so
Yeah.
you clearly applied it, right? And you've had to take that same formula probably multiple times too in every new area you're going.
Yeah, for sure. I mean, you're always like shedding the OU and developing to. I mean, what is you're here? We're here to grow, right? Every day you want to grow. You want to read. You want to implement. You want to be the better version of yourself, the best version of yourself you can be. So you have to be willing to shed that on you, that OU, to kind of grow.
Yeah, it's the other, speaking of the Tony Robbins part too, and whoever, right? But the idea of continue to expand that story because it's what we are, change your story, change your life type of thing.
Yeah.
How do you psycho-cybernetics, definitely a great one. How are you, I like to bring people on and talk about, how many times, Fuquan, have you heard about people building generational wealth, right? But I want to ask, like, what are you doing, if you don't mind sharing, like, how are you raising your next generation to think about?
No, that's a great question. Legacy is one of my favorite topics, and
Mm,
you've probably heard this before. It's not what you leave for people; is what you leave in them.
yeah,
And my greatest example are my boys. Right? They've seen me from the young age, laser focused, building. being a part of the journey. Also, I used to take them out with to properties. One of the things I would do with my kids is go, hey, I'm going to pay you $20. You come out and you record this for me. I need to give an update
Nice.
to my investors. And then they hear the jargon, they hear the language.
Yeah.
And then I, would show them certain things. Like when you would close, you would go over a HUD settlement statement with them and show them, hey, this is how much money the company made and this and that. And they get excited over that. And they want to be independent and they gravitate towards it. So for me, I made sure that when it came to that financial literacy part, that I did as much as I could because I didn't have that growing up. I had to learn on my own.
Yep.
And you'll see how it reciprocates in the future. I'm seeing some of that now, but it's what you leave in them, not for them, because they'll always remember those values and those things that you constantly spoke to them about. And when it comes to the financial literacy piece, helping them get a head start, and that's kind of for me what I'm doing for legacy. The other stuff are physical things that they can obtain themselves, and I would prefer for them to do that on their own instead of me just handing something to them because they didn't have the grit to build it on their own.
Yeah, but helping, I'd imagine, providing that environment so that it's conducive for that, right? So that they can have opportunities.
And even the other people that I come across, whether it's social media, someone's reaching out for help because they inspire, or anyone along my journey sharing the knowledge of things that I learned. Like I'm an open book. I don't, transparency is one of my core values. If I see someone's really willing to put the effort and they need some information, I'm gonna share the information. I've always done that. Even when I was doing the note business and I had the Note Academy, I was giving away stuff. People were like, what's going on? Why is this? It was the freemium process.
Yeah. Speaking of building relationships and education, you got some great resources on your site. I had a chance to check it out, ngcapital.com, your site. But you want people to go there to where's some of the other resources people can go to learn more about you?
YouTube. On my Fuquan Bilal YouTube channel, I have a lot of the renovations that I've done. On LinkedIn, I blog often on LinkedIn, my thoughts on what's happening in the market space, so you can find me there. I would love to connect with anyone. My site, you can schedule a call at ngcapitalfund.com. And if you're looking about a discussion on your current portfolio or some ideas you had, I like to build people. Real estate is therapy for me. So connecting with people and if I can help them along their journey and point them in the right direction, or just share some of my insights, is a great opportunity to add value.
I'm gonna make that bumper sticker and attribute it to you. Okay, Fuquan, real estate is therapy.
Yeah. Real estate talk is therapy. It's I don't want to say I'm a real estate junkie.
You can say
it. So talking real estate is therapy for me. I mean, it's really good. Again, you have to learn how to be an architect, and putting deals together, creative strategies is all fun. There's going to be some lessons that you're going to learn. You're going to take a few lumps, but you stay at it. It's like anything. Once you learn it, it becomes easier to understand, and the jargon helps you make better decisions. You become a better person that does due diligence. That's the key thing that I can leave with listeners is, a friend of mine used to say, make sure you do the do. Due diligence is major. The sponsor, the operator, due diligence on that person, due diligence on the investment strategy, thesis. That's going to be key for everyone.
Dude, go check out his LinkedIn, check out his YouTube and site, and look for a future Real Estate is Therapy LinkedIn post. Dude, appreciate you having you here. Thanks so much. Go check out his stuff. We'll see you next one.
Appreciate you.
Thanks for joining us on another episode of Path to Passive. We love connecting with our listeners and those on the path to architecting their wealth and improving their lives. Feel free to let us know what topics you'd like to see in future episodes. Get in touch with us through email or Instagram. See you next week for a new episode.